So I know what most of you think. I am only in my 20s. How can I start investing now? Well, what if I told you that now is the time to start investing? Call it a golden window, a once in a life opportunity to have an easy retirement. And I will show you how to do it the right way today. Reasons why you need to start investing in your 20s are: first, let me expand a bit more on why this is the golden window. You know how they say the early bird gets a worm. I know it's a little outdated, but that's pretty much it. Charlene Rhinehart, CPA and editor in chief of the Wealthy Woman's Daily, said it's best. While you are in your 20s, you should check in with yourself and think about the type of life you want to live now and what you envision for your future self. Then do some reverse engineering to make sure your current actions align with your vision. So start investing now and you increase your chances of reaping huge benefits when you hit that retirement number. But more importantly, you get to enjoy the advantage of risk averaging. See, most people invest and the market goes down and they lose money. That's when an amateur would pull out. But if you know what you are doing and you will stick to investing, and what this will do is soften the blow with time. The market will eventually go up and you will be able to cover that loss and make a profit on your investment. And then there is something called compound interest as well. In simple finance term, it means you will make interest over principal and the interest accumulated over the previous periods. And when you are investing in your 20s, that number goes up. If you find that hard to believe, you can simply check the numbers for yourself. You can find many compound interest calculators online, but I have made a very simple calculator which is attached in an Excel format in the description below. You will have to put some information like: number 1, the age you start investing; second, your retirement age; third, amount you wish to invest today; and fourth is the percentage return you expect from your investments, and it will give you the amount that can be created by your retirement age. Now what I would request you to do is, I want you to open that calculator and put the first number, that is your current age, as 20, the time when you start investing, and your retirement as 55. Assume you invest 1 lakh rupees today in an instrument that gives 12% CAGR return, and this calculator will show that you would create a corpus of approximately 50 lakhs by your retirement age of 55. That's 50 times of your initial investment. And now what I want you to do is change your current age from 20 to 45 and let other remain as it is. And you will notice how dramatically that number goes down at an age of 55 to just rupees 3 lakhs. Imagine, from 50 lakhs to 3 lakhs, this is what your age does to your investment. Earlier you start, the compounding gives you the best effect accordingly. Erin Wood, a certified financial planner and a senior vice president at the Carson Group, said, in your 20s, you have the superpower of time on your side. Compounding interest will be a huge benefit, even if you can only save a small amount. Let's also not forget that this is a great learning opportunity. I talked about risk management before, and well, in your 20s, you have fewer responsibilities on your shoulder, so you can take on losses. But more importantly, you will learn something from it. But near your retirement years, you will be forced to play it safe. And let's be real, that's no time for learning. So the next question is, how do you invest? Well, I will tell you how not to do it first. Don't listen to your friends, and don't be just another sheep in the herd. Most ambitious young investors don't know what they are doing. They have got that money and the spirit, but understanding is where the difference is. Study the market, know your playing field, and then make a decision. The options are endless, and if you don't want to rack your brain too much, you can simply go with mutual funds. What's the advantage, people may ask? Well, I think Jamie Taloumis said it best. She is a chartered financial analyst who serves as the portfolio manager at Reindeer's McWay Capital Management. So you know, she definitely knows the stuff. Anyways, she said, this removes the need to heavy research and monitor individual companies for someone who may not have the time or interest in doing so, while still allowing the investor to participate in economic growth over time. If I want to keep things really simple, there are two investment options for young investors who are just starting: equity and debt. Now, there's one rule that all seasoned investors stick to when it comes to deciding what amount they should invest where, and that's 100 minus your age. Say you are 20, then you can have 80% invested in equity and 20% invested in debt. Obviously, this is a thumb rule. It may vary from person to person. And then comes the next question. That is how to go about it. Well, I will tell you in a brief manner about that too. Your first option is equities. My suggestion is use ETF or mutual funds, as you don't need to do individual stocks research, as there are approximately 5,300 listed stocks in BSE and 2,200 listed stocks in NSE. And if you don't have time to do research in ETF or mutual fund, please consult a financial expert. As for debt, well, you have got many options like PPF, gold and debt funds. With PPF, the thing you need to watch out for is that these things have a lock-in period of 15 years. So once you are in, you are in. And if you invest early, you can get out of that lock-in period early. Of course, if you want to extend the PPF, you can. They hand out a lock-in period of 5 years in this case, which is another benefit of starting early. As for gold funds, well, gold always is a safe option. They protect against volatility. You should also consider this option for the simple reason that it's never a good idea to put all your eggs in one basket. So yeah, PPF is a safe option, but think diversification. And that's what all the great investors have recommended always. And a little tip, don't ignore your debt, that is your loans. If you have a student loan, pay them off right now. That helps you to avoid defaulting on your debt and ending up with a bad credit score. According to Charlene, the finance savvy woman I mentioned before, paying off high interest debt will allow you to save more and you can help to boost your credit score. And well, that's a small blueprint of what your investing journey is going to look like if you start in your 20s. Ideally, you do a whole lot more research, but hopefully this gives you an idea of what to expect. One important thing I want you to remember is to keep your financial goals in mind. All of us have a vague life plan, so just think on that before you decide on investing your money. My suggestion is short-term goals that are usually within the next few years and should be met with liquid cash or debt. For all long-term goals like 5, 7 or 10 years should be seen as separate goals, and that too long-term, where this money can be invested in equities using an appropriate amount of risk to match the goal's time horizon. Do let me know your timeline for goals in the comments below, and I will suggest you which asset class goes with the said timeline. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more valuable insights on smart investing. Share this video with your friends who are also in their 20s and they could use some guidance on starting their investment journey. Let's help each other to build a strong financial future. This is Ajay Menon signing off. Bye bye.